I have no model. I think you saw and listened many models. I have a story. It's a real and good story. I think it's bank examiner, and I have been working for over 25 years, and I supervise many banks. If I summarize the all bank supervision and risk management experience to me, if I have to choose one concept, it should be, I think, is concentration. In every risk aspect, credit, market, or operational. And I want to talk about is liquidity risk management in terms of liquidity risk management. And I focused the Silicon Valley Bank case. I think very important case about the liquidity and concentration. And my presentation plan is liquidity concept and its significance. Also, I want to talk about liquidity risk management principle and practices. And I just focused the liquidity and concentration on case of the Silicon Valley Bank. Also, I have some policy recommendation. Basic meaning of liquidity is just to be converted into cash easily. This is the very basic definition of it. And it's measuring, managing, and regulating is constantly evolving thing and often the debated field. And we can reach a consensus definition of the liquidity, but when we talk about the liquidity regulation, it's not easy because it's ambiguity area. Evaluate the liquidity is cash equivalent assets. Accepted the cash equivalent assets generally government bonds and very short-term financial investment, repo, depot, and swaps. As we know, the fundamental of liquidity item is cash, but cash equivalent financial assets is not the same as the cash. When we look at in a portfolio or a balance sheet, if there is any overly concentrated issue, we talk about in terms of many risks. It can be interest, credit, and liquidity, but one of the important aspects of this time is liquidity risk, because convert the cash is not just enough measure about the liquidity risk management principles. That's why the regulatory or other agency focused on the liquidity measures about the regulatory tools, because the liquidity measures one of the important aspects of the soundness and capital strength of banks and banking system. However, there are many factors about the liquidity risk and liquidity risk management: macroeconomic condition, balance sheet size, market capitalization, and many different perspectives and things is related to liquidity risk management. After global financial crisis, general consensus about the liquidity. It's a milestone thing, and this period produced a new set of banking liquidity rules. We call it Basel III rules. Actually, after global financial crisis and lately we experienced two big important bank failures, one of the Credit Suisse, one of the Silicon Valley Bank. Before this situation, generally banking regulation focused on bank assets. This is the big shortcoming actually. And after the period, the focus turned to bank liabilities because some systemic risk, some contagion risk arising from liability side. This is the very big important situation. In that point, talk about a little bit liquidity regulation framework because it's important. Actually, the banking activity is directly related to liquidity management. From the first bank, liquidity main issue and main policy side of the banking activities. Liquidity risk management activities in the banking, long-standing practice. But the first framework, officially framework, published in 1992, Basel Committee. The Basel Committee on Banking Supervision is the main regulator globally, and it's the first framework is published in 1992. After some crisis, and they introduced a new set of the banking regulation about the liquidity management in 2000. The big change, big milestone, is published in 2008, and after that document, we saw the liquidity coverage ratio and net stable funding ratio. This is today two main banking liquidity regulation indicator and tools for the globally. And one of the problem of the Silicon Valley Bank is the compliance to this net stable funding ratio. That's the importance of this regulation. When we come to Silicon Valley Bank is one of the largest bank failures in the US history. It's located in California and primarily served technology companies, especially startups. And Actually, it's before 2022. It's very bright trademark in the banking, and its profitability and its growth is a big success story. After the Fed's against inflation fight, raising the interest rate, and the story is dramatically changed for Silicon Valley Bank, because the Silicon Valley banks just primarily customers technology companies, and then they have large amount of deposit. Also, this deposit just demand deposit, and this is the very risky. Now you think your regulation just related asset size, but there's a big problem on your liability side. Silicon Valley Bank didn't actively in the credit policy. They just collect from technology money and they invest in the US security bonds, cash equivalent. We will see it is cash or cash equivalent. Some ratio of the Silicon Valley Bank, and this is really high ratio. When you look at, you see the same ratio for the US banks. This is the US banks ratio, securities / total asset, demand deposit / total deposit. Over the 2 times high Silicon Valley Bank, the same ratio. They almost their total deposit is demand deposit. This is very high liquidity risk. And also we can see the growth rate here. And sometimes some people see the growth is a success story, but if you are uncontrolled growth like the Silicon Valley Bank, almost 5 times over the US banking average growth rate, it's produced a great risk of the something about the banking activity. And from this historical occasion, we can get some lessons about the future and banking risk management perspective. If you have uninsured deposit from a single industry, this is really important, great concentration and liquidity risk practices. Also, your current bank supervision approach just only focused on banking asset is a big problem. You have liabilities and some liability problems. You always focused on the concentration, not just the liquidity, all kind of risk management perspective. And all banks need uniform regulation without any asset size consideration. For all banks have to have specific liquidity rules, and proper management of assets and liabilities along with effective supervision is essential for liquidity risk management. And also I want to come to Turkey. I researched all articles and academic studies. I didn't find any directly related to concentration issue. Generally, people try to examine some financial ratio and macroeconomic parameters, and they just try to figure the relationship and connection and degree of the connection of these. Some of them find positive financial ratio, some of them some positive macroeconomic indicators and negative financial ratio. Any directly related concentration issue. But I want to show just 2 important areas in Turkish banking. And these numbers from official numbers. One of them asset size. Securities in Turkish banking sector. Securities in the asset is approximately 20%. One of the important factors in the banking system, I think, is the liability size. This is our banking deposits. Over the 50% of our banking liability side it's belong to deposit. As a conclusion, this is the end of my story. And banks hold liquid asset because of the liquidity risk management, often government bonds, to ensure they can withstand with stressful times. Having more liquid assets generally improves liquidity, but it's also important to consider concentration of these assets, because concentration is just alone significant risk factor in both human life and the whole economic agent and general economy. Concentration just alone is a risk factor, and asset quality is not the point in here. And when we evaluate the concentration in the liquidity risk management, if you excessive any asset in the balance sheet beyond its activity, it can be a government bonds, it's not important. But if you dependence over the one asset, it's really big serious vulnerabilities in terms of financial stability and banking system stability. And that's why banks must carefully manage their concentration in all risk aspects, not just liquidity, credit, market, and other risk factors.